Welcome back, everyone. We are about to start our second paper session of the day. This is titled Risks and Opportunities in Consumer Finance. And as a reminder, please submit your questions in the Teams chat. And now, for our first presenter, I am pleased to introduce Devesh Raval from the Federal Trade Commission, who will present his paper about consumer surveillance and financial fraud. And Devesh, the floor is yours, and you can share your slides. Thank you.
All right. Thank you all thank you Raluca for inviting me to present in this conference, and to all of you for attending. This is joint work with Bo Bian at Sauder, Michaela Pagel at WashU Olin, and Juan Tang at Wharton. And as usual, the obligatory disclaimer applies. So this paper is about consumer surveillance and financial fraud. So I'll start with consumer surveillance. So we now live in a surveillance economy. So this is something that really is a huge change over the past 10 to 15 years. So all of us have a smartphone like this in our pocket. And one of the things that smartphone does is it tracks us using cookies as well as other techniques. So essentially, this phone is leaking lots of information about me, potentially where I am right now, which is a hotel room in Chicago, as well as, what I might be doing later on today, lots of information about me. So it basically allows a real-time constant surveillance because we always have a mobile phone in our pocket, and a lot of our life is now on the mobile phone. Now, this is huge. The kind of data uses that come up here show up in a lot of different places. Probably the biggest one would be ad targeting. So behavioral advertising that's using the information about you to better target ads. But it can be used for a lot of different purposes. And there are a lot of big players now that have this kind of data. For example, consumer data brokers, large platforms like Facebook and Google, as well as maybe the traditional data sources like credit reporting agencies. And now here, there's a huge change of all this consumer surveillance. One potential problem with that is the risks of this kind of data collection for consumers. So when you think about what are the potential risks for consumers for allowing data collection and sharing, there's several potential risks, but the one that we're going to consider in this paper is financial fraud. So fraud that's enabled by the fact that this kind of information is available out to you that can help target you for fraud. Now, I don't have time to go over the full background on this, but I want to talk about a couple of recent cases. So I work for the Federal Trade Commission that recently settled with multiple data brokers like Xmode and Outlogi, and is now in court against Kochava, essentially for data brokers, data brokering and selling of mobile data. So I'll talk a little bit about Kochava. So in the Kochava case, Kochava was selling location data and information from location data across tens of millions of devices. One of our concerns was that could be used to learn a lot about you. For example, did you visit an abortion clinic? Did you visit other types of sensitive sites? Another thing that Kochava advertised was that it could do household mapping, which is it could map your mobile data using where you live to other kinds of data about you based off of your address. So you can think of this as combining some of the traditional data sources linked to your name and address to all the additional data on your mobile phone. Now, the research question that we're going to target in this paper is, can privacy regulation reduce financial fraud? So I've talked a bit about data surveillance and fraud. Given the huge data economy, there's more and more concern about data breaches, identity theft, and so on. So that's one side of it. On the other side, privacy regulation is more and more important in DC, as well as the other regulatory places in the world. So probably the first to do this was the EU with GDPR, but California has a recent privacy law. the FTC as well as the CFPB are considering different types of privacy regulations right now. And so it's important to think about what the costs and benefits of that kind of privacy regulation is. And in this paper, we're going to consider one kind of benefit from that privacy regulation, which is the reduction of financial fraud. Now, the way we're going to get at this is using one major shock to the industry, which is Apple's ad tracking transparency policy. So if you look at the literature on privacy regulation, there are really two big natural experiments that people look at. The first is the European General Data Protection Regulation, or GDPR. The second is Apple's ad tracking transparency. Now, what Apple did is, on April 26, 2021, they launched a new version of iOS, which essentially required all apps to ask for explicit consent before sharing user data. So I want to highlight a couple of things about this privacy regulation. First, it was a default opt-out. So all consumers were opted out of tracking unless they affirmatively consented for tracking. Second, the apps only had one shot to ask you. So, if they ask you once and you say no, they can't keep asking you again and again and again. And lastly, there was a kind of a common visualization, which I've shown you here on the left side, across all of the apps. So this is a nice place to consider. This is a nice shock in some ways because it's uniform across all the different types of apps. It happens suddenly in the middle of 2021. And because of the default opt-out, most consumers opted out. So let me show you what happened. So because you were opted out by default, at the launch day, everyone was opted out. But even if you look several months later, more than 80% of consumers are still opted out. So we have a huge change here where all of a sudden, most consumers went from allowing tracking to denying tracking when Apple launches ad transparency policy. Now, this was a huge shock for the data surveillance industry. You can see that in the news. My co-authors had also looked at the stock returns for app developers, and they found huge negative returns for app developers after the launch of ATT, which is consistent with this being a major shock that reduced the amount of data that they could earn from selling data from apps. Now, there are a few ways that the ATT policy could reduce fraud. So first is on data itself. So this is going to mean less sharing of data, so less amount of data available. It's also going to mean it's harder to potentially match data. So I talked about Kochava that had a service that was household mapping and matching, online mobile data to addresses and so other types of data. Preventing data sharing is also going to reduce the kinds of matches you can do, which is going to reduce the kind of accurate or real-time profiling that you can do. And then finally, by not allowing the sharing of data, it's going to eliminate behavioral advertising based off of information, which could also be used through deceptive advertising to cause fraud. So you should think of all of these as ways that made fraud less efficient and less targetable. Now, the data we're going to use, so I'll first talk about how we get variation in ATT, and then which is the the independent variable, and then talk about our measures of fraud. So for the exposure for the policy, what we're going to use is actually data from a different data broker, which is SafeGraph. So we have foot traffic data from SafeGraph that importantly has differences by device type. So we can see for both grocery stores and banks at the zip code level, how many of the users are using iOS versus Android. That's going to be the variable giving us differential exposure per the policy. Some areas have more Android users, some areas have more iOS users. Now, for financial fraud, we don't have a direct measure of fraud. What we have is a signal of fraud, which is consumer complaints. And I'll talk a little bit more about how you might connect consumer complaints to fraud victimization. But we actually here have three different sources of information on consumer complaints. The first is public CFPB complaint filings. So this is a data set that any of you can go online and download. These are all complaints about financial products collected by the CFPB. The second is the Consumer Sentinel Network. So this is a major consortium of different government and non-governmental organizations collecting complaints, organized by the FTC. But this is going to have complaints from the CFPB, so it's going to include the first data source, but also complaints to the FTC, to the Better Business Bureaus, as well as to a lot of different state and local government organizations, the money transfer companies, and so on. So this is sort of a much wider data set. It's not as focused on finance, but it just has a much broader outlook. And then lastly, the FTC collects a separate identity theft database that's not a Consumer Sentinel network. So this database is focused on identity theft. So again, just like the CFPB is focused on financial products, the FTC's identity theft database is focused on identity theft. So these are going to be the main two data sources that we use, and then we're going to see how measures of complaints vary by the local iOS user share after the adoption of the Apple ad tracking technology. So here I can just show you the variation here. So the right-hand side is the variation in the iOS share. So the darker green has a higher iOS share. And you can see that there is a lot of variation across the country, both cities versus rural areas, but also regional variation in adoption of iOS versus Android. Now, the empirical specification we have here is a difference in difference type specification. The left-hand side is complaints at the zip code time level or zip code month level. And our main variable is the count of complaints per 1,000 capita. Then in terms of independent variables, the main variable of interest is the interaction between the iOS share at the zip code level and whether it's post-ATT implementation, so post April 2021. But we're also going to control for differences across locations through zip code fixed effects and differences across time through county month fixed effects. And then finally, we'll cluster the standard errors but at the state level. Now let me show you the empirical results. So here I've shown you the main results for each of the three databases, the CFPB database, the Consumer Sentinel Network database, and Identity Theft database. We get pretty comparable level effects in all of these databases. So for example, for CFPB, what this says is that post-implementation, a 10 percentage point increase in the iOS share, which is about a standard deviation increase, is going to reduce the number of complaints by 0.009 per 1,000 capita. It's about 0.01 for the Consumer Sentinel Network, about 0.007 for the Identity Theft database. So these are pretty comparable level effects. Though I do want to stress that percentage-wise, this is going to be much larger for the CFPB than either the Consumer Sentinel Network or Identity Theft databases. And that makes sense in some ways because the CFPB database is focused on financial issues, whereas Consumer Sentinel has lots of other issues. So people complaining about spam texts and spam emails that we don't think would be related to ATT. And I'll talk a little bit more about heterogeneity in a couple minutes. We also try to link this, so again, as I mentioned, consumer complaints are just a signal of fraud victimization. So I've done some research, so one of the things you find is that most fraud victims don't complain, but there are also potentially large demographic differences across zip codes. So in a previous paper in marketing science, show how the complaint to victim ratio, so the propensity to complain, varies by zip code demographics. You can apply that here and adjust the complaints relative to these predicted complaint to victim ratios based off of demographics. And if you do so, you find even larger effects of ATT on fraud victimization. So it seems like there are larger declines in areas with lower propensities to complain, which says that maybe fraud victimization fell even more than would just be reflected in complaints. Now, finally, this is a difference in difference. I want to show you the dynamics. So here on the left side is the dynamics for the CFPB. You don't really see much of a pretend pre-ATT, and then there's a significant decline post-ATT. If you look at the other data sources for consumer cellular network, it's pretty flat pre-ATT, and then there's a decline post-ATT. For the identity theft database, if anything, it seems like there might be an increasing pre-trend, although it's not significant, followed by a decline post-ATT. Given the interest of time, I won't talk about the robustness checks, although I'm happy to talk about them in the Q&A period. So in terms of economic mechanism, there are a few things that we've done to try to get at complaints that are more related to financial fraud that might come through this ATT channel. So the first is to try to take the complaints and identify stuff related to data security and data-related complaints, either through keyword searches of the complaint narratives or a zero-shot type machine learning approach on the complaint narratives that we do on the CFPB database. The second is to look at firm heterogeneity by combining data on firms with these complaints and looking at if there are changes for firms that have an app or share data with third parties and so on. And second, a different firm level approach, which is to look at data on cyber incidents at the firm level and see how those change post-ATT. And then finally, we also have done a little bit looking at the price of the dark web and looking at how that changes post-ATT. So in terms of looking at complaints that are potentially more relevant, for the CFPB database, we found there were two categories that seemed the most relevant. The first is credit reporting and debt collection, whereas things like student loans and mortgages were the least relevant. We find significant effects for the relevant categories, insignificant effects for the non-relevant categories. For the FTC databases, consumer cellular network and identity theft, we have the narratives for all of the complaints. So we can just look at narratives that have keywords that we think are related to data security and data things, for example, data breach. So we find large significant effects for complaints with narratives that include these keywords, and much smaller insignificant effects for narratives that don't have these keywords. So this is evidence that the reductions that we're finding are coming through this channel of data security that might come from ATT as opposed to other things. In a second, we look at firm heterogeneity by connecting firms with information about with complaints about firms with information about the firms. So this is a little bit of a different identification strategy. It's a different difference in difference, but we find declines after ATT for firms that have an app, both at the extensive margin and at the intensive margin. We also find larger declines for firms that share data with third parties or don't encrypt their data. When we try to combine this with cyber incidents, we find, again, larger declines for firms that have, and cyber incidents for firms that have an app. That's driven by information about data breaches or data misuse and not other causes of cyber incidents. We also see declines in cyber incidents that include a violation of federal regulations like the FCRA or the Fair Debt Collection Practices Act. And then finally, we have a couple snapshots of prices of data on the dark web, and we find post-ATT increases in prices for financial information and mobile type information, which again could be due to less data being available post-ATT for these types of information. Now, I want to conclude to give some time for Q&A. So what this paper does is try to quantify one of the major harms of excess consumer surveillance, which is financial fraud. Now, there's a lot of activity in this space. So there's activity from private actors like Google, for example, with Privacy Sandbox or eliminating third-party cookies. There's also a lot of activity from regulators. For example, the FTC is considering privacy and data security regulations. And so I think this will be a very active space in future. Thank you for all your time, and I would appreciate any questions.
Thank you so much, Devesh. We really enjoyed the presentation. So I'm going to read a few of the questions in the chat. Why didn't you use the FBI's IC3 fraud data? Is it because it may focus more on authorized, fraudulently induced transactions? This is one question.
That's a good question. So the FBI's IC3 database is in Consumer Sentinel. So it is one of the contributors of Consumer Sentinel. I don't know if we get all of the complaints in IC3, but we get the complaints that the FBI shares with us. I don't have access to the FBI's version of IC3, but I do have the Consumer Sentinels. But I don't know off the top of my head how things look if you broke it out just by IC3.
Thank you. Another question. How do data privacy policies like ATT affect different segments of consumers, particularly those that are less tech savvy or have lower incomes? And what are the potential impacts, economic impacts on businesses, particularly small and medium-sized ones, of implementing stricter data privacy regulations? Thank you.
So that's a great question. So there are two parts. So the first part, it was about differences across consumers. So I think a lot of that is going to depend on consumers' habits. So you could imagine some consumers have worse data hygiene, for example. Maybe they're more likely to install apps that share lots of data. We do look a little bit about this in this paper. We find some evidence, for example, that the complaints declines for Consumer Sentinel are driven by Blacks and Hispanics. So I think there is some evidence that there's heterogeneity across consumers. I think more could be done. On the small and medium business size, the only comment I'll make is that a lot of the data privacy regulations might potentially have carve-outs for small businesses relative to large businesses. So you might think of part of the data privacy regulation as a fixed cost. So that's going to be more difficult for small and medium-sized businesses. And so I think regulations could account for that by some types of safe harbors or carve-outs.
Thank you so much, Devesh. Other questions. How might emergent technologies such as AI and Internet of Things impact consumer surveillance practices and the associated risks of financial fraud? And also, can you say anything about long-term effects of data privacy regulations on fraud and consumer trust? Thank you.
So that is a hard question because we're just learning what AI can do. I think one of the things that AI could potentially do is make it a lot easier to link data across lots of different types of sources. You could almost also imagine AI making it easier to have somebody to chat with you that is good at seeming like they're a person. So those might mean more fraud. On the other hand, AI can also be used by firms and regulators to try to identify fraudsters and remove them. So I think the net effect is very difficult to say. And similarly, long-run effects are very, very, very hard to say. So, even in this paper, we're looking at relatively short-run effects. And given that the data privacy regulations are just starting, I don't think we know much about what the long-run effects will be.
Thank you. This is, I don't know, related, unrelated. Somebody's asking you, when do you expect to issue the next paper on price discrimination and overspending?
So that's my co-author's paper, so I don't know the answer to that. You have to ask them.
Okay, sure. And finally, can you tell us, do you see any evidence of consumer preferences shifting to companies like Apple, which prevent tracking, or is that an insignificant factor?
That's a good question. I think one of Apple's selling points is that it's more privacy protective than Google. I don't think we know much about what some fraction of consumers really care about that. I think there are other fractions of consumers that don't care at all about that. I don't know how this has affected their demand. I think to some extent, this is a place where people don't really know what is going on. So they're not aware that some firm like Kochava has their information and is selling it off. And so, they may not care as much as they should because they don't know what's going on.
Thank you. And I guess I'll give you one more and then we'll move to the next speaker. Do you have any thoughts on best practices that financial institutions and app developers could adopt to enhance data security and reduce the risk of fraud? And then how can companies better communicate their privacy policy to consumers to build trust and reduce fraud risks?
So
the
first question I won't tackle because I think that's probably better for a computer scientist or technologist. The second question is a great question because it's actually quite difficult now for consumers to know what's going on. So if everybody read the privacy policies of all the websites they go to, no work would ever get done. That's something I think we are trying to work on at the FTC, of ways to simply communicate the kinds of data that's available and not available. But I think there are simple things firms could say. For example, they could say, we do not sell your data, or we use your data to improve the advertisements that we show you, and so on. So I think there are simple things you could do that would be useful. So one thing, before I forget, so one thing that both Apple and Google have now introduced is privacy labels. So you can see them in the middle and the right slides. So you can see here the data that's used to track you, as well as the data that's linked to you. So that is one way that consumers can learn more about what's going on. There's other research showing that this has affected app demand. So app demand for apps that track you a lot falls once people learn about it. So this is an example of a type of technology that firms can do to help with that.
Okay, thank you so much. I think this is all the questions we have at this time, and we will then move to our next presenter. Thank you for being with us today, Devesh. We really appreciate your presentation, by the way. And now we would like to welcome Will Gornall from the University of British Columbia, who will present his paper on customer data access and fintech entry, early evidence from open banking. Thank you. And Will, the floor is yours now. You can share your screen. Thank you.
Thank you. And great, am I coming through?
Yes, I can see your slides. Yes.
Happy to be here today talking to you and happy to follow up on Devesh's super cool paper. That paper was looking at some of the costs of data sharing and how that can create risks. And this paper is going to be looking at, the flip side and argue that consumer-driven data sharing can create potentially a lot of value. So in particular, we're going to be talking about what's called open banking. So open banking is probably unfamiliar to most people in the US and Canada, although we're expecting open banking rules coming from the Consumer Financial Protection Bureau in the fall, the final ruling coming out, and we expect to see this rolled out across the US shortly. And in Canada, we already have rules, they just haven't been implemented for the last 3 or 4 years. Europe, though, open banking is very much a thing. And to show you what I mean, I have some screenshots from an app called Monevo. What Monevo does is it facilitates open banking enabled loans. So you want to get a loan for a car in the UK. Let's say you don't have a good credit history, or you don't have any credit history, but you think you're a good borrower. Maybe you're a student who moved to the UK to go to school. Maybe you're a recent immigrant. Maybe you just weren't able to get credit cards recently and you just don't have that history. That can make it hard to borrow money. That can make it hard to access modern financial markets. What the idea of open banking is it will allow you to provide your transaction data to fintechs, to competing banks, instead of your transaction data being contained within your bank and you having to print out pay stubs and fax them in to give that to another company. There's a secure pipeline that allows you to pipe your data from your main bank to this competing fintech or competing bank. The banks don't necessarily want to share that data. The open banking regulations force the banks to do so. So to illustrate, suppose you're a student, you're banking with Santander, you get your PhD stipend coming in every month, and you don't have credit cards because you've just moved to the UK from the US. Okay? What open banking could do is allow you to share your data from your main bank to a fintech, and by doing that, allow you to give that data to the fintech, and the fintech to be more comfortable giving you a loan. The fintech can now more easily verify your income. It can confirm your identity. It can learn about your spending habits from your transactions and get more comfortable with extending you credit despite you not having much of a credit history. So here, this is a snapshot of the UI. Unfortunately, in practice, there are many more legal disclaimer click-throughs, but the key idea is a consumer chooses to share their data with a fintech or competing bank, and that causes their relationship bank to pipe their data across to that fintech. So the authors of this paper, we think this is pretty cool. Bank customer relationships, relationship banking has information at its core. When customers, whether that's a business or a household, interact with a bank, they create lots of data. They get their pay, they do financial transactions, they pay their bills on time. When they don't, they get fees. They carry a balance on their credit card. All of that creates valuable information. All of that data right now is mostly held within the bank. You can get your data out, but it's hard. The options for getting your data out include sharing your username and password with a service like Plaid, which is what's called screen scraping, and that's undesirable. It's undesirable from a fraud security standpoint. It's undesirable because it's an additional friction from the consumer's perspective. You can print out your account statements and send them in. Again, that's a challenge. I'm not saying these are insurmountable, but they create frictions. They make it much harder for fintechs to acquire users because instead of having processed data, they're dealing with data coming out of bank systems in any format through a pipeline that has a lot of consumers stopping and discontinuing and not going through with getting a loan or whatever else. So these data are there. These data are trapped within banks. The idea of open banking is to force banks to allow consumers to share their data as they want, to force banks to create what are called APIs, application programming interfaces, that allow fintechs to pull data from banks with consumer permission. And what this paper is about is trying to assess the economic consequences of breaking banks' data monopolies. If you allow customers to share their information, what do you see? So these open banking policies that I mentioned are prevalent around the world. You see them throughout Europe. The UK was a pioneer here in 2019, Brazil, India, Russia, more places than I certainly would have expected. These policies are allowing customers to share their data, to get their data out of a bank easily through a program, through an interface, to allow apps to use the data that is currently trapped within big banks, Santander, Wells Fargo, Chase, etc. These data could be used for all sorts of things. It could be used as a way to verify people's identity. If you want to secure a purchase or you want to underwrite a loan, fraud is a significant issue. If someone can provide their bank data, that can convince you that that person is who they say they are, that that person is not someone who's stolen a credit card and is committing fraud. However, the current systems for sharing bank data are conducive to fraud because you have users entering their usernames and passwords into fintechs that they're not necessarily aware of that market. So the current system facilitates fraud. Open banking can reduce fraud. These policies are targeted at that, but the main thrust of them is innovation. These policies are targeted at facilitating financial innovation, facilitating competition amongst players, reducing the market power of banks by facilitating access to this data and facilitating easier switching, and in some cases targeting financial inclusion. The idea being that allowing greater information access will make it easier for people with limited credit history, with limited information, to get credit. In our paper, we do three things. First, we document and build out this big data set on open banking policies around the world. We document that there is significant heterogeneity amongst these policies, that they're taking effect in many countries. Secondly, we produce some empirical estimates of what's happening from open banking. So to preface this, we think it's still early. A lot of the effects of open banking are still to come, but we looked at the data and tried to figure out what are we seeing in the short term. We find three effects. First, we link open banking to venture capital fintech investments. If you allow fintechs to access banks' data, we seem to see more investment in fintechs. Intuitive, but perhaps surprising, because innovative investment is generally hard to predict and hard to influence. There are huge government programs to spur venture capital, and they're not necessarily effective. But maybe allowing fintechs to access these data is effective at getting fintechs money. Secondly, we look at consumers. We use data from the UK and show associations between consumer outcomes and data use. People who use fintechs that allow them to learn about their transactions end up learning about their transactions. People who use fintechs for credit end up getting the types of credit products that those fintechs could use. Third, we have perhaps the most tightly identified part of this paper. We look at data from UK SMEs. There was a regulation that changed, that made sharing transaction data with credit registries standard if an SME had revenue below 25 million. So we look around that cutoff and we show SMEs, small businesses, small medium enterprises who were below that cutoff saw significantly more fintech loans. If your credit report is enhanced with your transaction data, it appears that fintechs and banks are more willing to lend to you. So, like I said, those effects are all short-term. To get some information on the long term, we take a similar approach to what Lulu was talking about earlier, and we build a structural model of data flows of information in financial services. This is a quantitative model. Our goal is that these calibrations are meaningful, that they can be interpreted. And our goal was to figure out, how does open banking matter in the longer term as preferences, as the markets adjust? We found two big effects, giving you a preview of the results. First, the impact of open banking depends on how the data are used, depends on the product. If it is a data product where consumers are learning, where consumers are improving their decision-making, generally all consumers benefit. If you give consumers better ability to track their expenses or budget, everyone is better off. The second type of product, the story is more nuanced. If it's a credit product, the welfare effects are heterogeneous, and it depends on the assumptions of the model. If it's a credit product, the value that open banking creates for fintechs is allowing those fintechs to exclude bad credit risks. That's great for many people. It's bad for people who would be determined to be a bad credit risk. If you allow people with limited transaction history, with limited credit reports, to share more data, the people who have limited credit histories and good data are in, they get loans. The people with limited credit histories and bad data are in an even worse situation than before. I'll talk about that in a bit. We'll also talk a bit about how society-wide privacy preferences can change this equilibrium. All right. So to start off with, what do we mean by open banking? Here, there are a variety of forms of open banking. There are private data sharing consortiums among banks, which we think of as industry-led initiatives. But here we're thinking about government-led open banking policies. When regulators instituted policies to promote bank customers to be able to share their financial transaction data, to be able to port their data from their relationship bank to a competing fintech or to another bank. We get these data by hand collecting regulations for 168 countries, covering most of the world. We use official documents, law firm reports, news and industry reports, and then we cross-check these through Google searches and through a poor RA who went through all of these things after we did. So we have what we think of as a leading data set of open banking policy implementations. These data tell us a lot of stuff. I'm not going to go into that in much detail, but we think it's a pretty cool product, and we're going to be releasing it now that the paper has been accepted at JFE. So to give you a taste of these data, this is a world map showing the implementation dates of open banking policies. And you can see that, well, if you're an empiricist, you're looking at this and thinking this color pattern looks okay. We have policies passing at different times around the world. There doesn't seem to be a clear trend. Notable patterns are, well, India actually and the UK being early implementers, Europe implementing as a big cluster with the PSD2 regulations there, and the US being gray. When we update this, the US will become colored here because the US has, like I said, passed their own open banking initiatives through the Consumer Financial Protection Bureau. And given our regulators here, the exact organization of this varies by country. In some areas, this open banking guidance is coming from consumer regulators, in some areas, financial regulators, in some areas, the legislature, and in some areas through the central bank. So the first empirical test I'm going to show you looks at the effect of open banking on businesses. How are business outcomes impacted? So there are a lot of ways business outcomes could be impacted that we can't really tell. For example, a lot of the use of open banking for businesses is to allow better invoicing, to allow businesses to link their actual bank account transactions with their invoices and with their customers and customer relations management systems to get a better track of that. That's generally very hard to measure. What we can measure, though, is loans. In the UK, the vast majority of commercial loans are reported on and provided by the Companies House. We can use that data to look at how corporate loans changed around the passage of open banking. In particular, we're looking at how those corporate loans changed around the passage of the Commercial Credit Data Sharing Policy, the CCDS. This policy mandated the 9 largest UK banks to provide transaction data to credit rating agencies unless the companies opted out of having their transaction data shared. That policy, fortunately for us, only affected firms with sales below $25 million. So what we're going to be looking at is firms that had lower than $25 million sales and firms with above $25 million sales, and look at the differential effect of this around this CCDS policy. We can add in a bunch of fixed effects because we have a big sample here. Our goal is to see what happens. When we pass this data sharing regulation, do SMEs get more credit? And indeed, that is what we see. After the regulation passes, the firms that are within $15 million above the cutoff get many more new lending relationships. The firms that are $15 million below the cutoff don't. The firms that are below the cutoff and just qualify get these relationships. The firms that are above it and are excluded don't. These relationships these effects are significant. We're seeing about a 1.5 percentage point increase in the probability of having a new lending relationship. The baseline rate here is about 5%, so that's about a 25-30% increase. This increase is concentrated on, in particular, firms who had relationships with the banks that were forced to share. So we can look at an SME that had a relationship with Santander that was forced to share, and an SME that had a relationship with another bank that was not forced to share. If you had a relationship with a bank that was forced to share, you're more likely to have new lending relationships after this policy. So we can do a triple diff to get even tighter identification. We can also look at who these relationships are with, and we find evidence that these coefficients are being driven by non-bank lenders. So we see more non-bank lending relationships established for the treated firms after the policy, which is exactly what you would expect if fintechs are driving this change. So that's SMEs. Let's move on to talk about consumers. To speak to consumer outcomes, we pull data from the Financial Lives Survey, which is a large survey of UK households. They ask 4,300 consumers about their open banking usage and about their usage of financial products, actually a pretty rich data set. We find from this survey, a natural pattern emerges, and perhaps a surprising pattern, or at least it was surprising to me. When I started on this project, I'd assumed the main use of open banking would be credit, would be allowing people to augment their credit files to borrow money. But what came out of this survey is that the main use seems to be financial advice, savings, budgeting, the Mint app that Devesh had a screenshot of in his presentation, giving people better tools to track and manage their personal finances. We see about 9% of UK consumers report using these types of budgeting, saving advice apps. And perhaps 6% report using tools that allow them to get information or to allow them to produce information for credit purposes, lending, credit scoring, interest rate comparison apps. Moreover, these two groups are somewhat independent. The people who share to get financial advice are not much more likely to share to get better lending rates. All right, so looking at the data, we can also show that there is an association between sharing and financial outcomes. The people who get information on their transactions end up knowing more about their transactions. The people who borrow money through credit cards and personal loans are more likely to use open banking for borrowing. The people who use student loans and pawnbrokering loans are not. So why are we doing this? We're doing this as a partial placebo test. Credit card and personal loan lending could benefit from open banking information. Student loans could not, because of the structure of the UK market, and the same idea for pawnbrokering loans. Our argument is that the types of lending that can benefit from open banking are associated with open banking. This is potentially because consumers are opting into open banking to get better rates, and it's being driven to a large extent, I think, by companies operating in these spaces, pushing consumers to share to get access to better rates. All right. The final empirical part is a link between open banking and financial innovation. Here we're doing a staggered diff and diff setup, looking at cross-country data, looking at how venture capital investment in fintechs changes as a result of open banking policies. So in the previous section, I've showed some intriguing results on consumers and on firms, but keep in mind adoption, even in the UK, which is a leader here, is still fairly low. We're still very early into this potential data sharing revolution. I'm looking at fintechs here because I see venture capital investment in fintechs as a leading indicator. Venture capitalists are putting money into companies they think have the potential to do big things to change the world. So we can look at venture capital to get an idea of where smart money thinks innovation is going. And what we see is an increase in venture capital deals, an increase in venture capital fintech investments, and an increase in dollars invested after these open banking policies are passed. So year of the policy, the year after that, we see a significant increase of investment. And this is perhaps a 30-40% increase in the number of deals. What's the intuition? Well, there are two intuitions for this. The general intuition is that having access to customer data makes it easier to be a fintech. That could be driven by just general advantages, that if customer data is now available, there's all sorts of cool products that you can offer as a fintech that banks might not have been offering. Budgeting, tracking tools might make consumers better off, might make society better off. But it's also driven because fintechs now have access for free to a big pool of data. Intuitively, if you give fintechs free access to this valuable data resource, of course, you're going to see more fintechs. And we can look across particular industries. What we see is that this increase in venture capital fintech investment occurs broadly across areas, with the exception of digital assets. We think that's good. We weren't expecting to see patterns in crypto, and we don't see patterns in crypto, but we see patterns in the other areas we look at. So those empirical results are all intriguing. A big contribution of our paper, though, is to build out a quantitative model of OB effects. This model is designed to capture, well, a few specific things. First, we want to capture endogenous firm entry. The VC results suggest entry might be a big outcome of open banking, and the open banking policies themselves focus on entry as an important outcome that they're aiming to stimulate. Secondly, we want heterogeneous consumers. Open banking reveals data about consumers, and a big reason you want that data is because consumers vary in their needs and their creditworthiness. We have variation both on the consumer's type and on the consumer's privacy preferences. Some consumers are not going to want to share, other consumers are going to be more willing to share. Fourthly, our model has different data environments. We're going to be taking models calibrated off relationship banking, where one firm has exclusive access to a customer's data, and we're going to be porting that to a world with open banking, where the consumer can choose to share their data with fintechs. Our goal is to assess in the long run, in equilibrium, how greater data portability will impact consumers. We build this out using structural I/O models, and we calibrate those models based on two products. The first product is a credit product using data on non-guaranteed US residential mortgages. We think about this as a credit product where data could allow lenders to learn more about costs. Basically, some borrowers are more likely to default, some borrowers are more likely to strategically prepay, those borrowers are less desirable and more costly, and a potential fintech lender could use open banking data to learn about borrowers' type for that reason, to charge them more appropriate prices. Secondly, we think about advice OB, and here we're using financial planning. We think about advice OB as an example of customization, or of where information could allow a bank or a fintech to offer a better product, but not necessarily a better product by allowing them to charge consumers different prices, a better product by allowing them to deliver more value to consumers. All right, so jumping into the model, the big takeaway from our model, the high-level takeaway is that the effects of open banking depend on the data and how that data is used. In advice OB, everything is good. With a fintech, allows that fintech to offer you a better product, then everyone benefits. The consumers get better products. Fintechs are more likely to enter because they are able to offer better products. And the entry of fintechs increases competition, which improves consumer welfare overall. Banks probably don't benefit because now banks are facing increased competition, but consumers do because now there's more entry. Consumers are getting better products that can better meet their needs. The second case we look at are these credit products where data could be used for pricing. Credit products see the same type of entry and competition channel as advice products. If fintechs can learn who is a bad borrower and who is a good borrower, fintechs are better able to make loans. Fintechs have less of what's called adverse selection. If banks can see who's good and who's bad, the banks will only lend to the good people. That means the fintechs will get stuck with worse credit risks and be less profitable. That will cause the fintechs not to enter ex ante. So allowing banks to get more information on customers, on potential customers, means more fintechs will enter. It means banks will face more competition. This channel makes customers better off. The second channel is more ambiguous. Allowing fintechs and other banks to get more information on potential borrowers means the prices they charge will be more reflective of those borrowers' risk. That could be good and it could be bad. If you're a customer whose credit file doesn't capture your actual credit risk, that's good for you. Well, if your credit risk is better, if you always pay your bills on time and you have a stable salary, but you just never thought to get a credit card, then having your data shareable benefits you. You can share your data with a fintech, and that fintech can learn that you're a good borrower, and you'll be better off. If your data are not so good, well, then things are different. If your data are bad, if your data suggests you're a higher credit risk than your credit score would indicate, then sharing is bad for you. Importantly, sharing is bad for you even if you don't share. If all of the good borrowers, all of the borrowers with good data are sharing, when you don't share, it makes a lender think that you have bad data. You can think of the same idea with a credit report right now. If you have a credit, everyone shares their credit report when applying for loans. If you don't want to share your credit report, a potential lender is going to be very cautious about lending to you because they're going to assume that you have very bad data. They're going to assume that you are sharing your credit report strategically, and they're going to price your loan much higher or not lend to you at all. In a future equilibrium where everyone is sharing, we can have the same type of pattern where not sharing your transaction data makes a lender believe that you are a bad type borrower and denies you credit or charges you a higher rate. In our calibration, we quantitatively assess the importance of these two channels. Low-risk customers are always better off across the board. High-risk customers benefit even with credit OB because we find the entry and competition effects outweigh the negative signal of not sharing. If you're a high-risk customer and you don't share, well, you're not going to be worse off because the higher level of competition in the lending space outweighs this. The second broad point is that result on higher-risk customers depends on the aggregate privacy preferences. So what do I mean by that? If everyone chooses to share but you, then this kind of goes away. If sharing your transaction data is the norm, then not sharing your transaction data sends a really bad signal. If most people don't share, then the signal is much weaker. And in our model, that comes through on society level privacy preferences. If we're in a society where people have strong preferences for privacy, not sharing data doesn't send a bad signal because the bank interprets that as maybe you just really hate sharing data. If you're in a society where most people share, on the other hand, then not sharing creates a bad signal. So reason for caution here, because our results on equilibrium are depend on the society level. Sorry?
We have very few minutes left. I just wanted to let you know we have like 3 minutes left in total.
Cool. Well, those are the key results. So thank you all for listening to this presentation, and I'll leave some time for questions. Thank you, Rebecca.
Thank you so much. I'll read a few questions for you. What risks could open banking bring in situations where the lending relationships are exploitative, like non-bank lenders in relatively unregulated industries who could take advantage of consumers through methods like high interest rates? That's one question.
I think regulating potentially exploitative financing arrangements is generally very challenging. It's not clear to me that open banking is worse or better there. I mean, potentially, I guess, sharing your bank account data could allow those lenders to see where the money is and facilitate their easier taking of the money. But my impression is most of the people in this type of exploitative financing arrangement right now are stuck there in part due to a lack of competition. And it's not clear that creating better information sharing would make them worse off. If you're going to a payday lender or a pawn shop, then it's not clear to me why this could make you even worse off.
Okay, thank you. I'll just put one more last question and then I think we need to move on. Is open banking, you think, only as successful as the regulations or laws that simultaneously protect consumer data and privacy?
So right now, I think consumers are fairly reluctant to share. And that, I think, has mitigated a lot of the potential effects because people are untrustful of fintechs. They only share their data in a few cases, and I think we're okay. In the future, that could change. If sharing becomes normalized, like sharing your credit report is, then maybe we'll start to see worse outcomes. I can imagine a world where someone with, who pays a divorce attorney or who has cancer treatment bills will struggle to get credit because a fintech sees that on their credit file and doesn't want to lend them money. And that's potentially a challenge. Right now, all we saw for regulations was that countries that passed voluntary open banking, where banks did not have to share whether they could choose whether to share or not, saw no effects. If you don't force banks to share, they choose not to, and you don't get an effect from open banking.
Thank you so much, Will.